Hi, everyone. We're now going to take a look at Chapter 11, and specifically with project analysis and evaluation. So what exactly are we talking about this? Well, we have to evaluate how well we're predicting our cash flow and our net present value estimates. And this chapter deals with the tools we use to evaluate. So we're going to do what's called perform and interpret a sensitivity analysis for proposed investment, see which variables within our estimates are most sensitive to change, interpret a scenario analysis for proposed investment, determine and interpret cash, accounting, and financial break-even points, explain how the degree of operating leverage can affect the cash flows of a project, and how capital rationing affects the ability of a company to accept projects. So, evaluating net present value estimates. And what's very important to remember is that we are estimating when it comes to the cash flow of a project. So, we want to make sure that our estimates are accurate, or as accurate as they can be. We have to remember a positive net present value is a great start, but it's not the all end. We need to take a closer look. What are we looking at? Our forecasting risk. So what's really important to remember, back up, is that a positive net present value can mean one of two things, or a combination. We have a really good project, or we did a really bad job at estimating. So we have to look at this thing called forecasting risk. And what is forecasting risk? It's just the possibility that there are errors in our cash flow estimates. So how sensitive is our net present value, that calculation? How sensitive is it to change if our cash flow estimates change? So the more sensitive it is, the greater the forecasting risk. So we really need to look at and assess the economic reasonableness of our estimates. So we ask ourselves, why does this project create value? And maybe we're looking at things such as our project characteristics, like our product differentiation, the cost advantages. What kind of things are adding value? On the bottom of page 352 and top of page 353, before we start talking about scenario analysis, some things that we need to consider when focusing on what adds value. Third paragraph down. A basic principles of economics is that positive NPV investments will be rare in a highly competitive environment. So if there's a lot of competition, we may not have net present values that are positive when doing our capital budgeting and assessment. So we really have to identify and look at if we do get a net present value that's positive in this type of environment, why? Are we estimating well? And why does that happen? Because over time, prices will drop. We also need to think about potential competition when we're really looking at the value of our project. So if we're the only competitors in a market, maybe we can estimate pretty well, but what happens when competition enters the market? And it will. How will those new competitors affect our estimates? So we really have to drive down. We can't just say, oh, we expect $10,000 a year for 20 years. We have to take these other variables into effect. And that's what they're talking about. So forecasting risk is the chance, how much our net present value, how sensitive our net present value is to change. So the more sensitive it is, the more risk there is involved with forecasting, the more careful we need to be when it comes to forecasting. And then we have to look at these other factors like competition and really make sure we take them into our estimating process. So one tool we can use to really evaluate how well we are estimating is called scenario analysis. What essentially we're looking at here is what happens to that net present value under different cash flow scenarios. So when we're estimating, we should look at what's called a base case. High revenues, low costs. Worst case. And when we say worst case, we're not saying extraordinary worst case, worst ever. We're saying worse than best. Or I'm sorry, best case is the highest revenues with low costs. Worst case is low revenues with high costs. And then there's a base. Base is what we truly expect. Best is still normal, not extraordinary, but better than base. Worst case is worse than base, but not the worst it could be. Okay, so they're not necessarily probable, but they still may be possible. So if we look at the effects of these changes, these different cash flows on net present value, we'll have more information. And we'll really see, is this project worth undertaking? So when we're talking about worst and best case scenario, things you have to remember. An example I can give you that I'm looking at in front of me. Worst case actually happening, okay, is probably not going to happen. And one example is like the sinking of the Titanic, okay? There were a lot of little things that went wrong, none of it which were important by themselves, but in combination were deadly. A more recent example of worst case scenario is hurricane season in Florida in 2004. From August through September, there were 4 hurricanes that hit Florida. Previous to that, with that type of the number of hurricanes, there were 3 in Texas in that short a period of time in the 1880s. So it's 100 years ago. Okay, so when we talk about worst case and best case, we're not going extraordinary here. We're saying just a little bit better than base and a little worse. Worst for normal, best for normal, if that makes sense. So let's take a look at an example here. And this is in the textbook. The initial cost of an investment is $200,000 and the project has a 5-year life, whatever that project may be. There is no salvage. Depreciation is straight line. The required return on this investment is 12% and the current tax rate is 21%. The base, lower, and upper values are given in unit sales, price per unit, variable cost per unit, and fixed cost per unit within an Excel spreadsheet. Okay. And there it is. Oops. Let's go back. So let's take a few seconds. I'm going to share this screen with you to make sure you can see it. Okay. And let's talk about this. So we understand what all of these different variables are. Unit sales, of course, is the number of units that you expect to sell. The price per unit, so how much you're going to charge under normal everyday circumstances, $80. And that's what we're seeing right here. Variable cost per unit. Variable cost means as the more units that are sold, the more the price, the cost will increase. Or the less units that were sold, the less costs per unit. So this part of the cost of the product fluctuates or is variable, changes as the unit sales change. So for one more unit, there's $60 of cost. Fixed cost doesn't change. No matter how much you sell, your fixed cost or FC will be $50,000, whether you sell 0 or 10,000 under the normal circumstances. So that's what we are showing here. The lower is the worst case. Okay, the worst case, your sales would be $5,500. $75 is your selling price. Your variable cost would be $58, and your overall fixed costs would be $45,000. Best case, you would sell 6,500. The price per unit would be 85. The cost would be 62 for variable cost. The overall fixed cost would be 55,000. The depreciation on this is an 11.2, would be $40,000, which we click on it, you will see the $200,000 original cost of the project divided by the 5-year life, no salvage value. There's no working capital requirement. So in our best case analysis, the first thing we want to do, base case, I should say, not best case, base case, is take and determine what's the overall cash flow from the project. 6,000 units, $80 each would give us a $480,000 sale. The cost associated with those sales would be 60 times 6,000 or 360,000. The fixed cost is 500,000, depreciation 40,000. Subtract those three costs or expenses to get earnings before income taxes, 30,000. 21% of 30,000 gives us a $6,300 tax. That means our net income each year will be $23,700 under this scenario. When we're calculating net present value, what you need to remember is we are calculating present value of operating cash flows. So to determine operating cash flows, we're going to take our net income plus our 40,000 in depreciation. So under our base scenario, the cash flows would be 63,700. The 200,000 in original outlay would provide us with a net present value. Use your tools from chapter 9 to determine the net present value of $29,624.24. And in our Excel spreadsheet, they use the formula that's provided in Excel. Now, what about under our best case? Well, the best case would be the sales of 6,500 times 85. 6,500 times 62 would give us our variable costs. Our fixed costs are constant. Whoa. sorry. Go over here. This should be 55,000. That should be D5. Oh, sorry, hold on. Sorry about that. There was an error on the spreadsheet. I needed to fix it. Okay, getting back. So our best case then would be, again, our upper limit 6,500 times 85. 6,500 by 62 would be the first variable cost. Fixed cost would be 45,000. Depreciation is 40, giving us earnings before income tax of 90,500. Then subtract your taxes, 21% of 90,500 to give us net income. Net income plus depreciation would give us our cash flow. Take a look at that net present value. Best case scenario, 201,915. Worst case, if our sales go down to 5,500 with the $75 selling price, okay, then variable cost would be 5,500 times $62. Fixed costs were 55,000. Depreciation is still 40. Subtract your costs to get your earnings before income tax. Wow, negative 23,500. Taxes would decrease our loss by 21% to 18,565. Now, 40,000 negative 18,565 gives us cash flow of 21,435. Take a look at that net present value, negative 122,732. So this is showing us through net present value how our net present value will change. Okay. Scenario analysis. We're looking at a base, the best, the worst, and the impact on net present value. Now, finished with that. Let me stop sharing that and come back over and share our PowerPoints. Okay, so there were our best, worst cases. Now, we can take this a step further. Let's see what our internal rate of return would be. So remember, we would take internal rate of return on our calculator, apps 1, or you could be using Excel, go down to your internal rate of return, and you would put negative 200,000, and then your cash flow each year, comma, 63,700, comma, 63,700, comma, 63,700, comma, 63,700. And one more, 63,700. Close your parenthesis and enter. Oops, and I'm getting an error. Okay, but we can calculate our internal rate of return in your calculator using your cash flows and your initial investment. And you can see under the base, we get a 17.8%. Under our worst case, it's negative 17.7. And under our best, it's 47.9. Now, the suggestion is, in this kind of scenario, go somewhere in between base and worst, and somewhere in between base and best. Maybe do 5 different calculations. Sensitivity analysis will pinpoint where our forecasting risk is really severe. So what we look at here is what happens to net present value when we change one variable at a time. So what is most sensitive to any changes? So this is a subset of scenario analysis where we are looking at the effect of specific variables. So the greater the volatility in net present value, so the greater the amount changes in relation to one variable, the larger the forecasting risk associated with that variable. So you should pay special attention when you're estimating for that variable. Let's take a look. We're going to go back to our Excel. I'm going to stop sharing that, go into Excel, make sure you can see it. Okay, let's make this nice and big for you. Okay, so here is our sensitivity analysis for what we just did. We're back to this spreadsheet, best, worst, etc. And there was our net present value. Now in the first scenario, we are going to see how changing the amount of sales impacts our analysis. So now we will use the number of sales with the same selling price, same variable cost, same fixed cost and depreciation as our base. So we focus on this. The only thing we're going to leave all these variables the same. We're changing the number of sales. So that will impact our sale price and our variable costs, because the number of sales, the number of units for the worst case would be 5,500 times the $80. But for the upper, it'll be 6,500 units times the $80. So that's the variable cost. You'll still take the sales for each of the scenarios times $60. Fixed costs and depreciation are constant. This will cause our earnings before taxes to change under each scenario. Tax will be different because the earnings before income tax changes. So the net income changes under each scenario. So how is the cash flow impact? Well, cash flow again will be net income plus depreciation under each scenario. And now calculate the net present value. So you could use your formula or your calculator to calculate the net present value for each scenario. Base is our first, then worse, and I think it's best, then worse, right? Let's see. Oh, I'm sorry. I was going to say worst and then best. So they all stay positive if the unit of items sold changes. So there's no major impact in that respect. So you can see this on page 357, and I'm going to bring my PowerPoint back. So we're just showing you how to calculate it. Slide. Okay, and there it is. So even under the worst case, we still have an internal rate of return when we change the unit sales, positive 12.2%. So we're still positive with net present value, and we still have a respectable internal rate of return. Now, simulation analysis is a combination of scenario and sensitivity analysis. And it's really a complex situation, which you would need some type of software or computer calculations to complete. But essentially you're taking thousands of possible outcomes based on probabilities, distributions and constraints for each of the variables. So you're changing all the different variables and looking at all different kind of combinations. The output that you get will be a probability distribution for net present value. with an estimate of the probability of obtaining a positive net present value. So this simulation only works as well as the information that is entered, and very bad decisions can be made if care is not taken to analyze the interaction between the variables. So of course, this is a little bit beyond our scope, but we're just letting you know that we can combine scenario and sensitivity analysis. So scenario, how does net present value change and internal rate of return change from if we go our best, worst, base, and then trying to pinpoint which variables are most sensitive to change. Combining those two will help us to create even better estimating techniques, especially for those items that will impact or have a major impact on our project. Before you make a decision though, what's very important is we are very cautious of paralysis of analysis. Okay, we can look at all different kind of information and just get to the point where like, we don't know. We don't know what to do already. Okay, so you have to be very careful of that. At some point, you just have to make a decision. Okay, you have so much information, so many different scenarios and simulations here. You just have to try to make the best you can. So if the majority of your scenarios have positive net present values, then you can feel reasonably comfortable about accepting the project. What's really important to remember is if you have a crucial variable that leads to a negative net present value with just a small change in estimate, then you may want to forego the project. So what we're saying here is it's not going to be perfect science. You want to find the project that even at its worst, if it has some negative net present value, maybe you still do it because the worst may not even happen. But what you have to be very aware of is if you have variables that with small estimate changes will really impact your net present value and maybe even take it into negative, and then assess, could that really change? You may want to consider not doing the project, even if you have all these net present values that are positive. So it's a combination of these two items you really need to look at. Now, another common tool for analyzing the relationship between selling and profitability is what's called break even. And there's a couple different types of break-even measures. The first is accounting. And that is where we determine how much do we have to sell to make net income equal to zero. There's also cash break-even. How much do we have to sell to make our operating cash flow zero, which is different than net income, we know that. And then we have financial break-even. And that's the sales volume we have to do to make our net present value zero. So we're going to take a look at these three now. So let's say you have two types of costs. Well, first of all, there are two types of costs that are very important. We've already talked about them, variable and fixed. So variables change as quantity sold changes, whether it's increasing or decreasing. Fixed are constant, regardless of how much output there is. So total cost always equal fixed plus variable cost. Fixed, and we show you the abbreviations we use, which would be variable cost times quantity. Here's an example. Your firm pays $3,000 a month in fixed costs. Can't change that. You also pay $15 per unit to produce your product. What is your total cost if you produce 1,000 units? And what if you produce 5,000 units? So I can't remember if they take it or not. Nope, they don't. Let's go back. So what you do is plug it in. So fixed costs remain constant, 3,000 under either scenario. But your variable cost will change. For the first scenario, you would take 1,000 units times $15. So $15,000 would be your variable, total cost $18,000. For your 5,000, you would take 5,000 times $15 or 75,000. 75,000 plus plus 3, $78,000. So it's all based on how much products. That's what's going to change, and it'll change the variable portion of your total cost. We have to define what's average versus marginal cost. So the average cost per unit would be the total cost divided by the number of units. Total cost being the fixed cost plus variable cost. What's important to remember is that as the number of units increases, this average will decrease because your denominator is larger. You're spreading the fixed costs out over more units as the units increase. The marginal cost is the cost to produce one more unit, which is also the same as the variable cost per unit. So let's look at an example. What is the average cost and marginal cost for those scenarios we just looked at? Well, when you produce 1,000 units, the total cost was $18,000. Divide that by the 1,000 units and you get $18 per unit total cost. $5,000 units, 78,000 was the total cost. Now it's decreased to $1,560. So you can see how that average cost has decreased. The marginal cost per unit is still $15. That's the variable cost per unit. So how do we determine the break even when it comes to the accounting break even? So this is the quantity that leads to a net income of 0. So remember, net income equals sales minus variable costs minus fixed costs minus depreciation times 1 minus the tax rate. And we want that to equal 0. So if we do some algebra and move our variables around, how do we determine the quantity that needs to be produced for an accounting break even? And the final formula is below. Fixed cost plus depreciation divided by selling price of the product minus the variable cost. That will tell us how many we need to sell to create a net income of 0. Accounting break even is often used as an early stage screening number. So if a project cannot break even on an accounting basis, it's usually not even worthwhile taking it on. So accounting break even gives manager an indication of how a project will impact accounting profit, which is very important. Before we go to the next one, let's do a quick example. I'm going to go back over to Excel. And I'll share my screen. Okay. So, let's go to, Just give me a second here. Okay, so let's say you have fixed costs of $10,000, depreciation, I'm just making these up, of $2,000, selling price of $50, and variable costs associated with making this product. So these are the costs that change as products increase or decrease of 30. So how many do we have to make in order to make a net income of 0? Just take the numbers and plop them in our formula. 10,000 in fixed costs plus 2,000 in depreciation. Divided by oops, sorry. You could see that, sorry. Present value, or I'm sorry, present value. Selling price, oh, brain's all over it. Sorry about that. $50 selling price minus variable costs. So we get 12,000 divided by 20. So when we complete that, we get 600. And if you're looking, going 600 times 20, okay, so we need to make enough units so that we cover our fixed costs and our variable costs. I'm sorry, our fixed costs, our variable costs, of course, yeah, and our depreciation in order for net income to be zero. And think about it, yeah. So if we take our sales, they would be, and this should not, that should be a number, 600. Take 600 times 50. Variable costs would be 600 times 30. Take the difference, that'd be 12,000, right? Fixed costs are 10,000, so we would be subtracting those, and depreciation would be 2,000. So our EBIT will be zero, and there's no taxes and net income. So you could prove that out. So I just wanted to show you that. Let's go ahead back over to our presentation. Okay. Accounting break even and cash flow. So in finance, we're more interested in cash flow than we are in accounting numbers. Accounting worries about accounting numbers, right? As long as a firm has non-cash deductions, there will be a positive cash flow. So if a firm just breaks even on an accounting basis, cash flow is depreciation. So there will be extra money. If a firm just breaks even on an accounting basis, NPV will generally be zero. So let's take a look at another example here. Consider the following. A new product requires an initial investment of $5 million and will be depreciated to an expected salvage value of 0 over 5 years. The price of the new product is expected to be $25,000. So that's how much they're selling it for. The variable cost per unit is $15,000. The fixed cost is $1 million. So just like I showed you in the Excel, we take the depreciation, which would be 5 million divided by 5, or $1 million a year, added to the fixed costs, and then divide by what we call the contribution margin, or selling price minus variable costs, which would be 20,000. So in order to break even on an accounting income, the company has to produce and sell 200 units. Now, what about a cash flow? What is the operating cash flow at the accounting break-even point? It would be the $1 million, because the sales would come in as cash, the variable costs would be paid out as cash, and the fixed costs would be paid out as cash. But the depreciation that was deducted to get to 0 on net income would not be paid out as cash. So there would be a positive cash flow of $1,000. So what would be our cash break-even point? Well, take the $1 million in depreciation divided by the $20,000 in contribution margin, or the difference between selling price and variable costs. So for cash flow to be 0 from the project, it would be 100 units need to be sold or less. So accounting break even is where net income is 0. Cash break even is where operating cash is 0. And financial break even is where net present value is 0. So cash will be less than accounting, but accounting will be less than financial break even. Let's take another look so you can see this. Consider the previous example. Now assume a required return of 18%. Accounting break even was 200, cash break even is 100. What is the financial break even point? So our question is, when is net present value 0? So put it into our calculator. The number of periods are 5. The present value is 5 million. The interest rate is 18 because the required rate of return is 18. Our PMT would be 1,598,889 per year. And that is found on, let's see. I'm sorry, everyone, I have to stop the meeting right now. I'm going to save this as part 1, and then I'm going to wrap up the chapter with part 2. I lost track of time.